Josh, a couple percentage points difference doesn't matter in my total portfolio returns. Come on, man. What's the big deal? Watch. Because this goes back to fees, for one thing, first and foremost, but also to your location where you have your assets in terms of stocks and bonds, and actually how much you have in stocks and bonds. I'm going to show you right quick. And this is from Meb Faber's Trinity paper he did in 2016. He did a portfolio, a paper, I think it's a 20-pager on his Trinity portfolio. There's a lot of his back testing, which I always kind of question back testing, but I think there's some pretty good information here, which I want to share with you. All right, so he's got, my man Feb, he's got since 1926 to 2015, U.S. stocks, U.S. bonds, and a 60-40 portfolio, 60-40 stocks. The reason we say a 60-40 portfolio, because that's what everyone uses for a diversified, diversified portfolio, not too aggressive, not too conservative, right down the road, and that's what the 4% rule is based on, by the way. So the return historically from 1926 to 2015, this is the gross before inflation taxes, 9.95% in stocks, 5.26% in bonds, and 8.54% in a 60-40. All right, so not a big difference between 9.9 and 8.54. You're thinking not a big difference? Well, hang in there. And bonds are basically half of stocks. Again, this is before inflation. So a lot of people say, but man, in the Great Depression, I lost 83% of my portfolio, and I think I have it here. Yeah, you can see the various. Well, the blue is the stocks and the red's the bonds. So look at that. That's some significant down. And we're talking 80%, 40%, 50%, 40%, 50%. So that blue is the stocks and bonds. A lot of losses there for sure. And the bonds, the worst was 15.79. That's it. So you're saying, wow. So if I sacrifice basically half my returns, I have, I don't know, what's that, a six less of my portfolio in terms of downside risk. That's called drawdown, maximum drawdown. And so you say, well, sacrifice a half my return, I get 1/6 of the downside risk on a maximum drawdown. That might be something you'd consider. I hear that all the time. Conversely, what if I go 60-40? Well, I'm only getting about 1.5 points less. That's roughly 18% less. But I'm getting about 30% less, I guess, 25% less risk on a max drawdown. I might be inclined to say, does that really look worth it? I mean, I'm getting 1.5 points less a return, but I'm still getting killed on the max drawdown. I'm still losing 2/3 of my portfolio. And I imagine a lot of people say, yeah, I don't see the benefit there. So it's kind of like, you say, well, I'm going to do one or the other. I'm either going to go all into stocks and get that 9.95, even though I had a significant drawdown there in the Great Depression and all these other times I just showed you. Or I'll go in bonds and I'll take the 5.26 and be happy. And I think I can live 15% down. So remember, $100,000. If you had $100,000, you had $17,000 at the end of that right there, right here. $17,000. You start with $100,000, you had $17,000. The same thing's here. You start with $100,000. You're down, that's about 50%. You're down to about 50,000 there. I mean, the same thing happens. So it's not that easy when you're down 50%, down $50,000. So yeah, no big deal. I'm in for the long run. That's why I say stocks for the long run. And if itself aren't more safer. They're just not. Because look at this. When is it safer? When? Here's drawdown. So you said, well, if I invested here, it's safer? Well, no, because look, it's never safer. Because you're still getting killed. You're always dealing with the downside. And you don't know right here if that's going to be on March 9th, 2009. You don't know that's the end, that's the lowest is going to be. You don't know if it's going to keep going down. Like Meb talks about Russia and Greece and Brazil, China, all these other places. You don't know. I mean, look at Japan. All right. But anyway, so a lot of people say, I'm going to go here. I'll take the 5.26. I'm okay with that. And I can take a 15% decline. So I'm going to handle it there. Again, this doesn't look that good to me. And I'll even look worse here in just a second because you're still got the significant downside risk. And you're losing a pretty good amount of money on the upside as well. So let's see what $100 grew to after this time frame, which is basically 90 years. Let me grab my trusty pen. Yep, there we go. $100 grew. There we go. After the whole time, and this guy right here, we'll start with here. $100 grew to $10,146. So you put $100 in there, you waited 90 years, and you got $10,146. $100 grew here to $161,319. So here you're saying, okay, that's a pretty significant difference. You're like, yeah, that looks a lot better now, doesn't it? Because you're like, I got 161. $100 grew here to, you want to take a guess? 514,135. Look at that. So here you got, even though it's only more than 1.5% on an annual basis, that's about a 15 to 17% return. It gave you, what's that, $300,000, $350,000 more total. In your bonds, even though you only had 5.26, I mean, you only had 15% down. You only had $10,000 for 100. So, I mean, you can see the compounding interest of how that works. If you could have handled this right here, this is what you're rewarded with. And so the question is, why even bother with this over here? I mean, you're still getting a significant downside risk, but you left $350,000 on the table. You just might as well throw it all in with stocks and be done with it. All right, but that's over 9 years. All right, so let's say after 10 years, take our trusty calculator, put $100 in. That's our present value. Don't make any payments. Make sure we get my calculator set correct. Yep, okay, so $100 a year, present value. No payments. We get bonds 5.26 is our interest rate, 10 years, and our future value is $166. All right, let's do 20 years. 278. Let's do 30 years. 465, and we'll do 40. Can you all see that? Yeah, sweet. You can do 40. You'll see that. Yep. All right, cool. So 40, 777 dollars. All right. All right, so now let's do 60/40. 8.54 is the interest rate. We're going to do 10 years. 226. We'll say 7 is 226.93. 20 years. Oops. 515. 30 years. 1168. In 40 years. 2652. Yep, sweet. All right, so let's look at this guy now. 9.95 interest rate, 10 years, 258. So not a big difference over 10 years between that guy and that guy. It's just going to have this yawning gap between the two. 20 years, 666. Oh, 666, no! You ever wonder why atheists who don't believe in God, they even use the term 666? I don't get it. It's like, you don't believe in God. Why? It's just a number. Why do you care? Because they're trying to rub it in on Christians. Say, we don't care, so we're going to, well, why do you care? It's weird. It's just weird to me. If you don't care, why even mess around with it? All right. 1721. And after, what's that? 30 years, after 40 years, 4444. And that went interesting. So if we go back to 90 years, that's just crazy. Look at that. So at 90 years, it's 510, because I mean, I didn't change much of it, but 510. So anyway, look at that. So after 30 years, stocks gave you $1,300 more per $100. Bonds, and they give you $600 more for $100 in a 60/40 portfolio. But after only 10 years, you didn't get a whole lot of difference there, right? Even after 10 years, the bonds did okay, relatively speaking, but then you start getting significantly more here, and we're talking, $1,300 and thousands of dollars more. So the issue is, you got to figure out, am I going stocks or bonds? And this is why I like the barbell approach, because at least the cash you got, or the CDs, we know there is no downside risk. I'm not sacrificing much in the way of upside just because the CD pays roughly the same as a 10-year treasury right now, probably even a little bit more if you get the right bank, and you have more liquidity. So it's just so then you got to figure out, why would I go to a 60/40 portfolio I'm going to sacrifice a lot of return here over long term. I get that. But I'm not really giving up. I'm not as that safer. I mean, I'm just sorry. If you had $100,000 and you're down to 31,000, 39,000, 38,000 here, I guarantee you're not any happier than this guy's down to 17. You're not like, hey, I'm only down to 38,000. Woohoo! This other guy's down to 17,000. You're like, man, it sucks to be you because I'm only down to 38,000. No one's talking like that. The problem is that you see here, even though it's for 10 years, it doesn't look like that big of a difference. You're not getting 5.26 anymore. That's a big problem. And so what Meb Faber does, he goes to after inflation, and I'm going to show you let's see if he, after inflation is 2.91, and here's the difference here. When you factor, the red is the bonds, I think. Yeah, the red's the bonds and the blue's the stocks. So when you factor in inflation for the bond market, you can see significant. That's when the inflation rate was crazy. This one is low. This one is low here too, and this is when it's crazy from basically after the World War II until mid 80s or so. So you see the returns after inflation got pretty bad when you factor in inflation there for bonds. Inflation is the biggest thing for bonds for sure. In fact. Let's see. Your portfolio's, okay, here's what Meb says. Your portfolio's future returns are especially sensitive to each asset's starting valuation. In other words, the price you pay influences your rate of return. Pay a below average price and you can reasonably expect an above average return and vice versa. Bond yields are easy to forecast. If held to maturity, they should return whatever the current yield is. And when Meb had written this is 1.6. That's, I mean, literally, there's no other way around that. Bond returns are easy to forecast. If held to maturity, they'll return what the current yield is. Wow, where have you heard that before? All right, this points, and this right here is what he's talking about. This points to the difference, an important difference between stock and bond investing. While stocks often suffer from sharp price declines, as you can see in the blue, right? The blue's the stocks. From sharp price declines, bonds usually suffer from the slower erosion due to inflation. And while stocks outperform bonds over the long term, there have been periods of 20, even 40 years where stocks underperform bonds. 1929 to 1949, stocks underperformed bonds. 1969 to 2009, stocks underperformed bonds. And if you include the 1800s, there was a 68 period of zero stock outperformance, and that's because the money was strong back then. There was a gold standard of the whole thing that kept inflation in check. In fact, I don't know if I have it here, but in this article, yeah, we don't. Too bad. In this article, he actually shows the inflation in terms of when you look at the real monetary gains and losses relative to inflation. It's just very interesting. When inflation was not an issue, bonds and cash did just fine because there's no inflation eating away at their total returns. The point about this is we know you start with a low price, you're more likely to get better returns. That's fundamentally true. That's truth right there, the truth serum. Number two, we also know that over time, the difference between a tiny little bit of return adds up a lot. And what I would say is this also includes your fee. So don't forget, if you're paying a 1% fee, that's 1% that you're leaving on the table. So in this case, over the course of 90 years, you would have left $350,000 on the table because some guy's charging 1%. Look, I guess kind of facetious. Josh, I'm not going to be around 90 years. No, I get that, but the theory holds. Even after 10 years, you're still leaving this on $100, right? So if this was on $1,000, it'd be what, $2,500? Something like that. I don't know what it'd be. Anyway, 1,000 would be 25,000. It'd still be hundreds and hundreds and hundreds of thousands of dollars over time. It is the 1% fee you're losing. At the end of the day, you're not capturing anything for that fee. You're just losing money. Number two is, again, the starting price. You're paying a significant premium right now for bonds relative to historical norms. There's no two ways around that. No one would argue that. So all these people say stocks are expensive. Bonds are even more expensive. And we know that because the yields are so low. So because that, we got to look. We want to buy stuff on the value end as much as we can to lower the price in order to get more on the upside. Bonds just don't do it. It's just not there. It's just not there. And then you got to say, well, does a 60-40 portfolio actually do much for you in terms of rescuing it? And the answer is, my opinion, just not. All right. Hey, I hope you like this. Go to Meb Faber's website. I think it's Cambria Investment or something like that. I can't remember. But Meb Faber writes lots of good stuff, and his podcast is fantastic, too. We'll see you next time.